Welcome to Wealthion. I'm Wealthion founder Adam Taggart here at the end of the week, welcoming you back for another weekly market recap with my extremely good friend, upgraded again this week, Lance Roberts, portfolio manager from Real Investment Advice. Lance, how you doing, buddy?
I'm doing good. I don't know where you're going to go to from there, so we'll just have to keep working on that one.
All right. Well, folks, you might notice I'm in a different background here. Lance is telling me the connection of my Wi-Fi is not so great. Just quick backstory. I'm back in New England for my mother's memorial service. We're also cleaning out our house literally as I speak. So I told Lance I had to sort of sneak away and find a place to record today's weekly market recap. Found a hotel down the street and begged them to let me basically book this room for an hour and a half. And as I was slipping them the cash to do that, I began thinking, wow, they must really be thinking I might be doing this for some sort of sketchy purpose. And I said, oh, don't worry, I just need good Wi-Fi. And of course, then I thought, oh God, maybe they probably think I'm doing OnlyFans by the hour here. So anyways, Lance, feel free to make a tip here. Who knows? Let's see where this could go.
Exactly.
Interesting.
Yeah, but the hotel being not, surprised you actually made your bed afterwards. So, there you go.
All right. Well, look, we've got definitely some things to catch up on here in the markets. Bulls still seem to be in control. S&P is up about 100 points for the week so far. So I'll let you opine on the general market action for the week. I'll just color from a perspective standpoint. I'm definitely seeing a lot of people in the comments here. A lot of market bulls come out and kind of crow about, hey, you guys have been too negative on this channel. This market's unstoppable. And look, the market is what the market is. You and I talk about this every week, Lance. We're not necessarily rooting against the market or necessarily rooting for it. We're just trying to look at the data and figure out where it's going. But certainly the folks that are excited to see the market go up are getting increasingly confident that this thing's unstoppable. Maybe that by itself is a sign of sentiment.
Well, look, there's no doubt. First, so look, we turned bullish back in October of last year. Started looking at the market, kind of turn. You and I have talked about this every week. Is that a lot of the bullish, a lot of the bearish sentiment was just falling away, and that's recovered a lot. And if we take a look at bullish sentiment in terms of both positioning as well as just general attitude of investors, it's we're back to kind of FOMO territory that we've seen previously. And the important thing about that is that can last a while. Just because we're getting very aggressive in the markets and people are getting very excited in markets, and absolutely right, all the bulls are definitely coming out of the woodwork now and kind of coming out of the bunker going, okay, it's fine. But this can last, and sentiment and kind of momentum in the markets can carry this market a lot further than you think. And this is why you have to be really careful about being negative. Bull markets last a lot longer than bear markets. When you get a bear market, and a real one, and I'll explain the difference why last year was a correction and not a bear market. But when you get a real bear market, those tend to last 18 to 24 months, and then they're over. Bull markets tend to last 3, 4, 5, 6, 7 years. So once you kind of get that bullish turn in the markets, they can last a fairly long period of time. Now, there's a few caveats to this that go back that we can discuss. But right now, anyway, analysts are coming out. We're now looking at all-time highs by the end of the year, according to Wall Street analysts. That's that momentum kicking back in here in terms of that bullish sentiment. Just kicked off earnings. Really, we had a couple of earnings yesterday, but earnings started officially today with JP Morgan, Bank of America, Wells Fargo, all reporting much better than expected earnings. Not surprising now, because we had downgraded Q2 estimates a lot from last year. So they're beating a very much lowered hurdle in terms of earnings. If we had left estimates where they were in Q2 of last year, when we first started reporting these back in February, every company would miss. But because we lower that bar so much, we're going to have a nice earnings season. UNH just beat their earnings. Of course, United Healthcare just took a big whack a couple of weeks ago because they said, hey, our earnings are going to get hurt because old people are now electing to have a lot more elective surgery. They're having knees done and hips done, and those type of things. We're seeing a lot of those coming in, which is impacting our margins. And even today, stock's up 2.5% at the open this morning because they beat earnings, right? But all that was getting priced in ahead of earnings. So this is always why we call this millennial earnings season. Everybody gets a trophy, and that helps markets lift in the short term. And that's what's going on right now.
All right.
Excuse me.
There have been some predictors out there that have had not too many people are doing this, but a few are predicting, have been predicting, extreme growth in the S&P, almost more as like a last hurrah, not to maybe this current bull market cycle, but the big secular bull market cycle is measured like over the past 40 years, right? And there's one or two out there that have made pretty extreme predictions, like 6,000 on the S&P. And I'm seeing more people come out and say, hey, those guys now might be onto something, right? And maybe, right? I mean, we were in the battle of control range between 3,800 and 4,200. We've broken out. We're now above 4,500. And that's material. And there's momentum behind this, like you're saying. But it's a pretty big jump from 4,500 to 6,000 on the S&P. In terms of sort of where you see this kind of going from here, do you see us, I know this can go higher for longer than most people imagine. We've talked about the disconnect between the macro data and where prices are. But in your mind, do you see a run to some height like 6,000 as likely here, or would you expect a lot more road to be hoed before we end up in that type of trajectory?
Well, so that's kind of a really big, interesting question. And Michael Leibowitz, my partner, wrote a really great article on Wednesday of this week. It's on the website at realinvestmentadvice.com, where he was analyzing a recent Fed paper talking about the end of an era. And so there's a couple of things that are going on that may suggest that we have lower rates of returns in the future. And again, over a longer period. Now, in the short term, could the market melt up and go running off to 6,000? Sure. If the Fed came out, cut rates to zero tomorrow and started doing quantitative easing versus quantitative tightening, and we saw liquidity increase in the markets, absolutely. In the short term, this market could certainly have some legs here and go higher. But when we start talking about what was driving returns and earnings over the last 40 years, and this is important, I've got an article out today on the website, realinvestmentadvice.com, shameless plug, but talking about long-term stock market cycles and talk about full market cycles. And if you go back and look at the current market cycle that we're in, it started in 1980. And yes, we had a couple of periods there where we had zero rates of return for 15 years. That's normal in a full market cycle. But we've never done two things. We've never violated the long-term uptrend since 1980, and B, we never reverted valuations. So that's something that occurs during a true, honest bear market. You have a valuation mean reverting event that is very protracted. We saw it back in the 70s. We saw it back in the 20s. And those were the end of full market cycles. And so we're clearly still in that full market cycle. Now, what was driving that full market cycle, and this is the important part, is that we had continued expansion of earnings for 40 years. And that was driven by a 40-year period of contraction of interest rates and tax rates. Back in 1980, the corporate tax rate was the what we call the realized tax rate, or what the tax rate that companies actually pay. The tax rate people quote say, oh, we need to raise the corporate tax rate to 35%. Nobody pays that, right? There's a real tax rate that everybody pays, which is always substantially lower than that amount. So back in the 80s, the statutory tax rate was much higher, but the real tax rate that companies paid were about 35%. Today, it's closer to 10. Yes, I know the corporate tax rate is 21. It's 10. That's what companies actually pay. And so when you have this contraction of interest rates, which allows companies to generate higher profit margins from lower expenses on lower interest expenses, and you're paying less out in taxes, then that's going to give you a big boost in earnings. So what the Fed paper discovered, and what Michael Leibowitz did a good job of analyzing, and he looks at companies like Coke, Clorox, Pepsi as good examples, because these are your mature, kind of growing blue chip companies that have the biggest benefit from kind of earnings manipulation, so to speak. What the Fed paper stated is about 40% of profitability came solely from lower interest and lower tax rates. And that's exactly what's happened with Coke, Pepsi, and Clorox. If you take a look at their earnings over the last period of time, about 40% of their earnings came from lower interest rates and tax rates alone. And we're talking about net income here. This has nothing to do with stock buyback. So this is all about net income. And so the question you have to ask yourself now going forward, if we're going to maintain a valuation level of 30 times earnings, which is where we are right now, what is going to be the driver of stronger earnings over the next 10, 20, 30 years? Because interest rates, yes, they're at 4% and they may go back down to 2%, but that's a far cry from going to 8% to zero. Right? It's also a big difference when your actual tax rate is 35% to 10 versus 10 to 0, and the tax rate isn't going to 0 for companies. You're probably at the lower end of that tax rate now. I mean, it's just there is a function that they still have to pay some taxes, even though companies can get around it to some degree. But it's going to be very hard to compress 10% to 0 to get some type of negligible benefit to earnings and profits. So this is going to be a challenge for the markets going forward. Certainly doesn't mean that we can't have spikes in the market where you get the market taking off because you have, the Fed cutting rates to 0 or doing some type of liquidity intervention. But that seems to be a much harder case to justify that is sustainable long term. And so eventually valuations, as is always the case, are going to start to revert back to a mean. And if you take a look at the rally this year, it's entirely driven by valuation expansion. There is no earnings expansion at all. Earnings are still contracting. They're just not as bad as people thought they were. So when you're running a market entirely on valuation expansion, you're really putting a lot of risk on the ability for companies to generate much higher rates of return in an economic environment with higher interest rates that we have now, and a constriction of bank lending and other on consumers that are going to make it harder for them to spend at elevated levels. Remember, at the end of the day, corporate profits and earnings have to follow GDP because that's where they come from. They come from economic activity. So if GDP is slowing, which it is, then economic growth, the economic growth rate of earnings is also going to slow down. Even though we may be recovering, they're still going to be much lower than can justify current valuations, if that makes sense.
Great answer, Lance. And look, as you look ahead for the next couple of decades, and we see that profit growth is going to be challenged to be as much as it's been in the past, and that taxes aren't going to be able to come down as much as they have in the past. You briefly mentioned just there at the end, higher interest rates. Do we suspect that interest rates will, over the past couple of decades, we had a big declination in interest rates as well, right? Whether we'll have higher interest rates from here or not, TBD, economists can duke that out, but we're not going to have the same type of multi-decade, declines from, high teens cost of capital down to basically 0, right? So that's one more thing that's not going to be helping the markets, right?
Yeah, no. Look, interest rates on the longer end of the curve, right? So again, we talked about this before. The Federal Reserve only controls basically 2 years and in. So the 1 month, the 3 month bills, the 1 year bills, the 2 year treasuries, that's what the Fed controls. And and you can look at a chart of the 2 year treasury rate and the Fed funds rate, and they are perfectly 100% correlated. So that's what the Fed controls. That's your credit cards. That's why interest payments on credit cards are now 22%. They've had a sharp spike, right, in correlation with, of course, higher Fed funds rate. On the long end, anything longer than 10 years, that's all controlled by economic growth and inflation. Economic growth and inflation are falling. Economic growth nominal was about 12% with that $5 trillion worth of liquidity. That's coming back down to 2 on a nominal basis. The inflation rate, as we saw this past week, of course, a big driver for the market this week. Inflation is falling sharply. CPI headline was at 3%. PPI is falling rapidly. The spread between PPI and CPI is negative 10% now. So, that disinflation that we were talking about last year is really coming home to roost now. So interest rates as they function will go back to 2% or less, and it'll equate with long-term economic growth. So as real GDP drops down towards 1.5% to 2% growth on a more normalized, stabilized basis, that's where interest rates will be. So yes, 4% of the 10-year treasury back to 2%. That's not going to be, again, to your point, when you go from 8 to 4, that's a big difference in 4 to 2. Yes, it's 100% decline in both cases, but it's I'm sorry, I said back that up. Yes, it's a 50% decline in both cases. My math isn't working well today, apparently, but that is not the same in terms of in terms of the impact to the bottom line of corporate profits and earnings. And so, yes, these things are going to fall. We cannot sustain higher levels of interest, over time, because we just simply have too much debt in the economy. The government right now is dealing with what is going to be roughly $1 trillion in interest payments alone from higher interest rates. So that's all going to be forced down to a lower denominator in order to sustain and support what economic growth we can actually generate. But that doesn't bode well for corporate earnings and profitability and sustaining multiples of 30, 35 times earnings, in the future. If we get to 6,000 on the S&P, and let's just say that happens, and is it possible? Certainly, anything is possible. But now you're talking about valuations back to 40 times earnings, simply not sustainable in this environment.
Okay. Yeah, and you mentioned right where I was going to head next, which is this isn't, at least in the short term here, we're heading into an environment where, because of the higher cost of capital, the U.S. debt payments, the interest on the debt is becoming crazy, right? As you said, right. We're almost about to hit 1 trillion, right? Just some quick stats on that. So we are still deficit spending pretty aggressively. Our deficit spending surged in June to almost 650 billion. That's 100 billion higher than just a year ago, right? Our fiscal year-to-date deficit of 1.4 trillion is up 170% versus the same period last year, right? So we're still kind of spending like a drunken sailor to a certain extent on the Fed side, but the cost of that debt is really beginning to bite. And while the interest payments are going up fast, federal tax receipts are falling. So in the past trailing 12 months period, they are down 7.3%. So, basically we're spending a lot more on servicing our debt. We're taking on more debt at a fast clip. And yet the income that's coming in to pay all that is declining. You look at that, if a household were doing that, that household would be going into declaring bankruptcy pretty quickly, right? Governments don't necessarily have to do that, especially if they have a printing press for the world's reserve currency, but it's still not good, right?
Yeah. And the important thing is, we talk about recession indicators, by the way. And if you take, leading economic indicators have been talking about a recession. The National Federation of Independent Business, that says a recession is coming, inverted yield curves. One of the other kind of, leading indicators of a recession in the economy is a contraction in tax payments. And that makes complete sense, right? If the economy is slowing down and I'm not earning as much money, then I'm going to pay less in taxes. And that is typically where recessions come from.
Right. So there's less income to tax.
Right,
yeah.
Right. And so when you have the type of decrease, in fact, I'm going to write an article on this here shortly, probably the next week or so. But when you have this contraction in tax revenue, that is typically, and again, there's no previous precedent in history where that didn't correlate to a recession, but hey, anything's possible, right?
Yeah. Well, so let's if we can, let's firmly grasp that chest beating that the bulls are doing right now. What I'm trying to do is I'm trying to remain open-minded, right, to any and all possibilities. You and I do a good job of doing the back and forth, and I'm usually more a little bearish and usually a little bullish. But we always kind of come around to the fact that, hey, if you're looking at the macro data, it's really hard to come up with a credible, long-term, or sustainable bullish argument here. And I do want to flag an interview that I just released on this channel 2 days ago with Eric Basmajian, who is a younger guy, but very sharp analyst, actually a little bit of a protege of Lacey Hunt. They actually communicate. It's impressive that a guy at this age has gotten Lacey's attention. And we walk through a number of his charts. He tracks economic cycles. And what's really interesting about his work is when he looks at something like, say, the employment market, he breaks it down into its leading indicators, its cyclical indicators, its non-cyclical indicators, its lagging indicators, and basically shows that in most cases there is a progression of how these indicators flow, right? Obviously, leading goes first, and then that goes into the cyclical, and that goes into the lagging. And when you look at things like the employment market, leading indicators very clearly have rolled over big time, right? You can see it begin to start infecting the cyclical numbers. They aren't negative yet, but the trajectory is down. Very clear that they are weakening, right? As you would expect, you would see leading first, then it would get into more cyclical. Same thing with the aggregate numbers, which kind of just throws everything together. And of course, the lagging ones are the ones that have least to move the most yet, but that's because they're lagging, right? By definition, right? But you can kind of see, but what I'm saying is in his charts, you can see the progression of what certainly looks like the arrival of recession. And when I gave him the chance to say, what do you think? He said, yeah, I really don't see how we avoid recession, specifically because as I'm looking in my charts, this is exactly what you see when you go into recession, right? We just haven't gotten to the point yet where it's hit enough of the lagging indicators where everybody can see it visibly all around them yet. But certainly, the data is bad and lots of increasing anecdotal evidence. But that said, I don't want to be the guy saying there's definitely a recession coming and definitely we got to be bearish all the time. So, there is hey, markets can be irrational more than you think, and we'll just sort of watch this market continue to rise until it doesn't. But is there more to that? Is there more of a bullish argument than we can make here beyond just simply momentum and excessively optimistic sentiment right now?
No, not really. It's very hard to suggest that there's a stronger underlying factor to the rally of the markets. As I said earlier, there's a difference between a correction in a market and a bear market. And so what is the difference between a correction and a bear market? So a bear market is really defined by a change in the price trend of the market. Now, I know the market runs around, they say, oh, a 20% decline in the market says it's a bear market. That is really not true anymore. That was an arbitrary number that was kind of picked by Wall Street, about 4 decades ago when, back then, the market was not so deviated from its long-term trends that a 20% decline would break that prevailing bullish trend of the markets. The problem today is because of all the liquidity since 2009, the deviation between the long-term growth trend of the markets and the price of the market is so elevated that it would take nearly a 40% decline just to get back to the long-term trend. So the definition of a bear market is simply this: the previous prevailing trend of higher prices is now broken, and the current trend of prices is now lower. So the trend of prices is now falling, and you've broken that previous, trending of higher prices in the markets previously. We never did that in 2022. The second real caveat for a bear market is a reversion in valuations, at least back to their long-term growth trend, if not normally a reversion below that. We didn't even budge valuations really to any degree at all in 2022. Okay, a correction is a little different. A correction in the markets now, and I'm going to leave this up to you. I'm not going to answer the question. I'm just defining what a bear market is and what a correction is, and I'll let you decide what you think we're in right now. But a correction has several facets to it. One, it never breaks the previous long-term prevailing trend of the market. And B, it quickly recovers back to all-time highs. So we're now within, basically about 6% of the market reaching all-time highs. So if we recover back to all-time highs by the end of this year, and we never actually corrected valuations, and we never actually got close to the previous long-term bullish trend of the market, you tell me, was this a bear market last year, or was it a correction within a prevailing uptrend? And the reason this is an important situation is because if we don't have a mean reverting event that corrects valuations, it's very hard to create that long-term exponential growth trend going forward that you need to create much higher prices relative to what the market can actually generate, or the economy can actually generate.
Yeah, and you if you don't have one of those corrective periods, or really kind of a cycle of those corrective periods, taking the steam out, periodically, you run the risk of what I think John Hussman warns of, right, where the market gets so far ahead of itself that you can kind of end up with a lost decade, right, where you've just pulled too many future gains into today that the market has to just churn through them over a very prolonged period of time before you begin to hit new highs again, right?
Yeah. And that goes back to our previous conversation, talking about tax rates and talking about, interest rates. The differential between what the market, when you take a look at the market over the last 40 years, they've been generating about 7%, growth rates in net income versus what the economy can generate, which has been roughly around 4%. So if we're dropping to about 2% growth on the economy, then and interest rates and tax rates really can't drop a whole lot from there. It's going to be very challenging for earnings to keep growing at 7% and net income to keep growing at 7% in an environment that is generating 2%. So it's that spread between, the reality and what's going on. But look, in the short term, this is, what's happening in the markets right now. It's FOMO. It's, we talked about this in October of last year. It was, on the decline, it was the fear of missing out on the decline, and nobody wanted to be in the markets. And then I said, look, as soon as this market bottoms, there's going to be the fear of missing out on the gains, because everybody was emailing me, telling me, Lance, just tell me when the bottom is so I can buy.
Right.
And that's the case. And everybody that was, we had a lot of clients come on last year, and they were like, oh, I don't want any risk. I want to be in the bond sleeve. I don't want, now they're like, why aren't we all invested in tech stocks? Because, and I told you this would be the psychology of the market, is that as soon as the market started running, everybody would forget about, what was going on last year. And that's where we are. And so this is what's driving the markets near term. But again, we have to go back to the fact that, the market's running really on hope, which is they're hoping that the July FOMC meeting is going to be the one and done rate hike for the Fed, and no more rate hikes. And if the Fed's done hiking rates, the hope is then that the Fed's going to start cutting rates and reintroducing liquidity back to the markets. The problem that the market is really setting itself up for is that there's no reason, if the markets are running up, the economy's doing okay, we're not in a recession, there's no reason for the Fed to cut rates. Now, eventually, yes, I think there's a very high potential that we're going to have a recession next year. All the indicators are telling us that. The lag effect is still, clearly, being pushed out because of all that liquidity that's been supporting on the markets. Whether or not the Biden administration can do a workaround for the student loan payments, we'll find out. But as of right now, those student loan payments restarting are kind of that trigger. I wrote an article about this last Friday, that student loan payment is kind of the trigger potentially for a big contraction in consumer spending, which is 70% of GDP. So, if there is a setup for a recession in 2024, there's certainly some triggers out there that suggest that could be the case. And, that's certainly going to lead to lower earnings and some disappointment, because the market's getting way ahead of what reality potentially looks like next year.
Yeah, and I just want to reiterate too that in part of the market's assumptions that you said the market's hope, right, is that the Fed cuts interest rates. As you said, it's probably unlikely to cut them anytime soon, given the current environment. But if we get into that recession, maybe now it's looking like later this year, or probably next year, the Fed may cut rates. The market is hoping that, rate cut means asset prices go up. But we've talked about many times, almost every time we've gone into a recession, when the Fed has been hiking into a recession the way we are right now, you have quarters of rate cuts before the market bottoms.
Yeah.
Right. So it isn't like a light switch where, oh gosh, okay, the Fed, cut rates, great, happy times again. Usually it means sell when the Fed starts cutting rates.
And I think that's still the case. We had a bit of a conundrum last year. And I shouldn't say it's a conundrum, but we had a bit of an anomaly. That's a better word last year. Because normally when the Fed is cutting rates, normally when the Fed is hiking rates, which is what they were last year, normally the market is going higher because there's a lot of momentum in the market. The Fed's, hiking rates, saying, oh, we're hiking rates here because we want to make sure the economy slows down a little bit. So the market tends to be okay with that. And within the Fed pauses their rate hikes, and then the market declines because all of a sudden now you're in the recession. The anomaly last year was the Fed was starting to hike rates fairly aggressively, and the market was selling off because everybody was going, oh my God, a recession's coming. And, we talked about this last year, is that if we had a recession, it would be the most well-forecasted recession ever in history. And so because that everybody was expecting a recession, we said it's probably not going to happen when you think it's going to happen. Now, the good news is if you're really bearish and you're looking for, that event to come, we're now getting to where everybody's going, oh, no recession is going to happen. The recession is done. We're going to have a soft landing or a no landing scenario, and earnings are going to start growing again, and the economy is going to take off. It's going to be great. It's all, sunshine and roses and waterfalls. But now, but the issue is now is that if that lag effect does show up, you've now got the psychological environment to allow that surprise impact to occur that creates that waterfall event in the markets where people start going, okay, I need to sell stocks because there's no way in a recessionary environment that NVIDIA is going to be able to grow at 50% a quarter, that type of thing. And the Fed will be cutting rates because a recession is setting in, and you will have that correction in the markets. Now, let me be clear. That does not mean you're going to have a catastrophic 50% sell-off in the markets. That's probably not going to happen. But, a 15, 20% decline, certainly well within the cards of a recessionary environment.
Okay. Yeah. All right. Great. It's going to be interesting. There's that old saying, a bull market climbs a wall of worry. Right. And that's sort of what the market did the first half of this year, right? Everyone still had the same worries they had all of last year. And then the bull market said, you know what? We think you guys are too worried. We're going to start, hold my beer. We're going to start taking things higher.
Exactly.
What's the equivalent saying on the bear side? If a bull market climbs a wall of worry, what does a bear market do? Does it shreds a wall of hubris?
Yeah, I guess, there's really not a saying for that.
Let's coin one. Let's come up with one.
Yeah.
But basically what you're saying is that this optimism or this potentially hubris, is now setting the market up for the negative surprise, just like an overly negative market lets the bulls take control.
Exactly. Look, and again, in the short term, and again, this is the important thing, right? Where do investors make all their mistakes? Look, where do I make the most of my mistakes? I let my
coming on this program.
Yes, coming on this program. But no, when I make investing mistakes, and I made one this year, I'm too underweight equity from the beginning of this year, and I'm being penalized on performance for that. I'm also being penalized on performance this year because I run more of an equal weighted portfolio. And if you take a look at the S&P 500 equal weight index versus the S&P 500, there's a massive performance gap between that because of the top 7-10 stocks that are driving the S&P 500. So I'm getting penalized on two fronts. I can live with that, right? Because I'm still, very conservative and I want to protect my clients' capital. But what was driving that equal weighting analysis and the allocation of the portfolio was concerns about these recessions. And again, looking at these longer term trends and economic stats of the markets, it was saying, hey, look, there's the risks that are out there. We want to try to avoid some of that risk. Where we got caught was this immediate exuberance in the markets that just came flooding back. Retail investors came jumping back into the markets with both feet, throwing parties and all that type of stuff. And that happens. And this is why in the short term as investors, we have to focus on sentiment, positioning, and technicals, because that's the only things that drive the markets over a 1-year period is sentiment, positioning, and technical. That's it. Liquidity. That's all there is. Fundamentals matter over the long term. So we've got to make sure that we can have a long-term view and a long-term focus. That's fine. But if we're trying to trade the markets and make money near term, we have to set some of that stuff. Sometimes we have to set it on the side of there and go, yeah, I realize that's the situation. But right now, this is what technical sentiment and liquidity is telling us. And that's where we have to kind of focus near term if we're going to navigate markets. But it doesn't discount these long-term fundamentals that are going to matter. They just don't matter in the short term. This is why valuations are a terrible technical indicator for the markets. You should never trade your portfolio based on valuations in the short term. Valuations tell you everything about long-term returns. They tell you absolutely zero about returns over a 1 to 2 year period. So
okay,
that's why you have to balance these things very carefully.
That's a great point. And this is why I really want to sort of roll up our sleeves and just tackle this, this cheerleading right now going that the armchair bulls are going on, which is like, hey, you guys just missed the train. It's all about making money and it's easy to make money in today's market. And you guys are missing the train. And look, I'm happy to take any criticism into account here and for us to try to figure it out. But you just said a couple really important things there. One is that valuations tell you everything about the long run, right? So if you consider yourself a long-term investor, which I think most people watching this channel are, right? I think we've got few traders watching this channel, some, but I think they're in the minority, right? So if you're deploying your money based upon valuations, then, lean back. Like as long as you've got good position sizing, good diversification, ideally a good advisor who is watching all this stuff for you, don't worry about the day-to-day or month-to-month or even necessarily quarter-to-quarter if the fundamental reasons for why you placed the valuation trade are still true, right? There's going to be noise. Go ahead.
Yeah. No. I think that right there is the most important message that you can deliver. First of all the people that are tagging you now, like, oh, this market's easy to make money. Yeah, they said that in 2021 too. And this was the same group of people that basically lost 50 to 70% of their portfolios. And that's what the retail data tells us during 2022. And so, yeah, they're making some money now, but all they're trying to do is lick their wounds and get some money back. They're not making more money. And
they're cherry picking their time horizon. Like, yeah, easy to make money from January to now, but if you go to the previous January to now, you're still down a lot. Yeah.
Which is the point. And we said this on the channel before, and I can't reiterate this enough because look, I'm having the same experience with clients right now. And like I said, my mistake this year, too cautious, underweight equity exposure, let fundamentals and economic data, kind of cloud the view of being a much more aggressive in the markets I should have been. And look, we've been increasing equity. Don't think I'm just sitting on my hands. We've been increasing equity exposure all year. And we're now up over 50% equity exposure, but we're still underweight to 60 that we should be in our 60-40 model. Again, it's just we've not had a good entry point to go to full target weighting, and we will if we get a correction. Now, but here's the point. The same people that last year were going, oh, I don't want to lose any money and I want to be super conservative in the markets. Our portfolios vastly outperformed the markets in 2022. Yes, we're underperforming this year, but we are making money. And, that's the problem that the media does in general is they say, well, how are you doing this year? The market's up, 13% this year. How's your portfolio doing? Well, how's your portfolio doing from 2 years ago or 3 years ago? Because if we're truly investing long-term, what happens in a 6-month period means nothing. What matters over a 3 to 5 year period is what you're looking for. Are your assets growing? Are you beating your hurdle rate? Are you doing the things that you need to do to grow your wealth? Or are you spending a big chunk of your time just trying to get back to even? That's these are the important things to think about. Yeah, we get all tied up in the hype of the market this year. And look, I'm guilty like everybody else. I look at things, how's the market doing this year? Where am I? I've got to figure out how to close that gap some. And that's my job as a portfolio manager. But it's a terrible way to manage your investments and manage your wealth building process, because you are going to wind up taking on too much risk at the wrong time. You're going to wind up losing a bunch of money, just like we saw happen to retail investors last year is a good example. They got all bulled up in 2020, 2021, completely good reasons to do so, forgot to sell, in 2022, thinking that, oh, it's all going to be fine. This is going to happen repeatedly over time. And this is why I just wrote an article called Stock Risk Doesn't Decline Over Time, but I've got another article coming out talking about long-term bull market cycles and why, we just spent 40 years in a ripping bull market cycle from 1980 to present. And if the investing worked like the media tells you it does, why is it that 80% of Americans don't have $500 to spend, right?
Right.
And why is it that even people that are invested have less than 1 year's salary saved up? Yes, it's a function of too much spending and bad financial planning and all those type of things. But if the market was doing what everybody says it does, you just put money in, it generates 8% a year. We should have a lot of really wealthy people in the U.S., not the breakdown of the 1% versus the 99.
That's a great point. That's a great point. All right. Well, look, I want to continue to grab this tightly for a moment. So the question I'm getting to is, one of the benefits of having you on this channel every week, right, Lance, is giving people a view inside the mind of a capital manager, right? A guy that just can't have an opinion. He's actually got to marshal client assets, based upon his best view of the world. So the question I'm getting to is, how does a guy like you navigate a FOMO market, right? A market where the stocks are moving and you want to participate, but you're also nervous because you don't trust the fundamentals of this, right? But real quick before we get there, I want to underscore something that you said, which was you are underperforming the market this year. But first off, you are making money for your clients, right? So however you are positioned right now, it's such that your clients are getting a positive return this year, right? So first off, I want to make sure it's really clear. You are self-flagellating here. The market's doing better than I am this year, but you're still making money for your clients. So let's be clear, you're not losing money for them. And secondly, it's I don't want to say it's unfair because look, we're professionals. We just got to take, the comments as they come. But for someone to point and say, hey, you missed the boat, the market's on fire, you're underperforming the market. I can't think of any credible capital manager who at the end of last year would have said, you know what, the smart thing to do is to put 100% of my portfolio in the FANG stocks right now, right? Because that's what's driven this market, right? It's literally 7 to 8 stocks that are responsible for pretty much all of the market's performance so far this year. So that's just reckless. I mean, nobody has that kind of crystal ball. That would have been a highly, it would have been called for. It would have literally been too reckless a decision, right? So I just want to say, yes, you and probably every other capital manager out there is underperforming the market right now, but it's for valid reasons, which is, hey, we have to abide by the time-honored principles of good wealth stewardship. We have to have position sizing. We have to have diversification. Coming out of a year like that, to all of a sudden go 100% long in some of the most speculative stocks, that's just not something a credible, responsible manager does. So anyways, I want to give you a chance to opine on that, because I do think that comparison, it's a pretty unfair comparison in the sense of it's like comparing the guy who goes into the casino and just puts it all on red, right? Yeah. It's like, yeah, the guy had an amazing night that night, but you shouldn't expect it every time you go into a casino.
Well, right. And look, and this is what I was saying earlier, with a lot of retail investors, yeah, they're absolutely going in, they're chasing all the, kind of the hot stocks right now, and they're doing fine. And that's great. But they have forgotten the pain they went to last year, where those same stocks they're chasing today lost 70, 80, 90% of their value. And so it's a big difference when a stock goes from 100 to 10, right? You lose 90% of your money. And then you buy the stock at 10 and it goes to 20, you go, I made 100% return. You're still way underwater. And this is where most investors are still living that case right now. But look, the reality is I have a job to make money for my clients. And so I have to navigate the market for what it is. But I have to do it in a way to try to manage risk at the same time, because the one conversation I've never had to have with a client is saying, Mr. and Mrs. Client, I'm sorry I lost 50% of your money last year, but this is how we're going to get it back. Mm-hmm. Never had that conversation. in the markets that were down last year, we were down less than half of the market last year. Yes, we were down because the markets were down. We still had some assets in the markets. In October, when we started talking about the death of the FANG stocks, we started adding to our FANG stock exposure. But I'm not going to put 100% of my clients' money into Microsoft, Apple, and Google. We own them. We've owned them this year. We've added to them this year. They're helping the portfolio perform for sure, but they don't make up 30% of the portfolio like they do in the index, because again, it's just not prudent to have that much money of a client's involved in just a very few number of stocks that, one morning you could wake up and Apple's down 40% because of some reason that we can't even fathom. And that can happen. And it happens.
Right. Just including NVIDIA in that mix, Yeah, I'm going to put you 20% in a stock that's trading at 40 times sales, right?
It's not,
there's so much that could go wrong with that. And if it did, you would justifiably be, subject to severe criticism, maybe censure from the industry for that.
Yeah, oh, absolutely. If I did that and we got, look, there's, the thing about being an advisor, it's fine and dandy. And here's an important thing, right? Always consider where you're getting your investment advice from. And the reason I say that is there's a ton of people on YouTube right now, on TikTok, everybody else throwing out investment advice. Oh, just, get on this app and buy this stock. And I see guys all the time that, on YouTube, people send me videos of, hey, here's a guy that day trades on TikTok or YouTube or whatever. And he tells you all about how to technically trade stocks. And it's all great information, but these guys are not registered. They do not have any oversight from the SEC. So for me as an advisor, I'm regulated by the industry. I have a fiduciary responsibility. And so if I don't take care of my clients from this fiduciary front, I'm subject to censure, fines, et cetera, from the SEC. But more importantly, I'm also open to lawsuits from clients because they sued their advisor. Oh, the market was down 20% last year and I was down 40%. And so they file a lawsuit. These lawsuits never go to court. They always wind up in arbitration. They're always settled in arbitration because the insurance companies go, just pay the people and move them on. But that's how, these things get done. And this is what happens. And so, people that are in the industry that are regulated, that are fiduciaries, they have a responsibility to take care of their clients. It may not be what the clients want. The clients may be, hey, put me all into NVIDIA stock because it's just killing it right now. And we've got to take the responsibility of saying, no, that's not prudent. That's not good for you. That's not risk management. And if you insist on doing that, you can't be a client. You've got to move on to somewhere else. And that's got to be your choice, because even if we did it, if the client wrote a letter that said, put me 100% in NVIDIA, sign it, I will not hold you responsible. As soon as that stock loses 50%, we're in court. And he's going to get his money back because the court's going to say your job was to keep him from doing that against his best interest. So that's the big difference about making sure the guy on YouTube, he doesn't have that liability. So if he tells you to do something and it fails and you lose all your money, that's on you. That's not on him. And that's why, make sure that you're getting your advice from, somebody that has not only skin in the game, so to speak. In other words, they eat their own cooking. My money's all invested in my own portfolios. So, I eat my own cooking, and that's what you want to make sure your advisor does. But also you want to make sure they have a legal responsibility to look out for your best interest, even if you don't think it is in your best interest. They have a job to do that.
Yeah, no, great point. You want a good advisor who's smart and taking all the right things into consideration, but also who has the incentive to make sure that you do well and are protected, and not even just an incentive to gain, but an incentive that, hey, if you don't do it, if you're too reckless or imprudent, there's going to be real penalties for you. All right, so sort of last question around this, but this has been an important discussion because I'm really hoping that people see what a capital manager has to go through, right? It's one thing just to sort of look at how the top 8 stocks are doing. It's another to really just look at, okay, how do you play in that world while abiding by the time-honored principles of wealth management, right? I mean, again, when GameStop was shooting the moon, yeah, you could have gone all in on GameStop calls and made a lot of money for a short period of time, but then you would have lost absolutely everything, right? So I'm trying to make sure that the the bulls who are dancing on the bears right now. I'm not telling you not to be bullish. I'm just telling you to be carefully prudent about how you operate from here. But last point on this, Lance, which is, so it has been a FOMO market, particularly over the past quarter or so. How do you play that?
Well, so, we've been just slowly trying to find opportunities to add exposure to our portfolios in areas that, just this week, as an example, early this week, we added, Google has had a decent little pullback to support recently. So we added some more money to our Google position. Apple had a bit of a correction. We added a little bit of money to our Apple position. We were already kind of in a good position with Microsoft that we had added to earlier this year. We added to our AMD position recently on a pullback that it had. So we've just been kind of looking for these individual areas of the markets to try to use opportunistic entry points to add some exposure, but we're still doing it in very small bites, because what we're hoping for is, look, in any given year, you're going to have a 3 to 5% correction. And we're going to have a 3 to 5% correction, maybe in August, maybe in September, maybe in October, we'll have a correction. And the bears are going to come running all back out and say, see, I told you it was a bull trap. And now the bear market's back. No, it's just going to be a correction. Probably pull us back to the 50-day, maybe even the 200-day moving average, which would be fantastic, but that'd be closer to a 10% decline. But that's even normal within any given year of the market. But that'll give you a much better entry point. And when we have that type of a correction, we'll pretty much go to full target weight at that point. We'll selectively pick areas that we want to add into. We talked about sector rotation earlier, over the last couple of months. We were expecting the sector rotation. We had, on one end of the spectrum, we had technology, communications, and discretionary, all super overbought, and everything else was super oversold. Now that's completely rotated. Technology is now moving into oversold, and all the stuff that was out of favor is now coming into favor. So the breadth of the market has certainly improved recently, and that's a good sign, right? That gives the bulls a little bit more support here, that we're broadening out the advance of the markets. But again, everything's getting a little bit ahead of itself. So we need a correction at some point to provide a better opportunity to put money to work. And we'll see if that happens.
Okay. So in a FOMO market, while the FOMO is still raging, I'm going to summarize here, correct this any way you like. You're basically saying, so you want to ride the trend, but you want to look for pullbacks or even better corrections to add to your positions in the leaders here. Because if I understand correctly, you don't trust this in the long run. You'll be executing that game plan in the short term. What are you going to look for to begin to say, you know what, this thing looks like it might turn. Fundamentals may be looking like they're going to start mattering again. How are you going to be positioning yourself near the edge of the dance floor to get out when the time is right? And what are you going to look for?
So it's kind of everything in reverse, so to speak. So, right now we're in a market where we're buying dips. And so as markets are going up, we get a pullback to the 20-day moving average, the 50-day, whatever it is, we're buying that dip. We're putting that money to work. When we begin to have a correction, so let's just use a real basic example. Let's just use the 50-day moving average. So everybody can go home and kind of pull up a chart of the 50-day moving average on here. I'll tell you what, let me borrow a screen real quick.
Go for it.
So this is a chart of the S&P 500, and overlaid on this in red is the 50-day moving average. The blue is the 200-day moving average. This is just a very basic, simple, technical chart of the market. So right now you can see that we've been in this very nice rising bullish trend ever since really the October lows. And so every time you come down to the bottom of this trend or come down to some level of support, that's been a great opportunity to add into positions in your portfolio. We're now fairly deviated above these long-term moving averages. So the first thing that I would look for is I would look for a pullback to, say, this 50-day moving average, this red line. And if the market holds there, I would probably add some exposure to the portfolio. But let's say, for instance, that all of a sudden the market breaks that. That's still nothing to worry about. But now we flip our script from buying dips to potentially selling rallies. And what we would be looking for at that point is the market rallies back up to the 50-day moving average and then turns back lower. In other words, it fails at that support level. So we would probably take some money off the table at that point, say, okay, let's wait and see what happens next. Then the market declines to the 200-day moving average. and say, okay, everything's still fine. We're still in a bullish trend. Nothing has changed, but we certainly have some weakness in the market. We're still going to sell any rally that goes back towards that 50-day moving average. So now the market rallies back towards the 50, maybe it doesn't get there, but we're going to sell into that rally a bit, raise a little bit of cash, reposition the portfolio a little bit more defensively. Then we take out the 200-day moving average, still not a confirmed downturn yet, right? The markets, as you see back here in, earlier this year, in March, we violated the 200-day moving average after getting above it. And so all the bears came out and said, oh, see, broke the 200-day, time to get out of the market again. That was a bull trap, be back in. But you can see here very quickly, it got back above the 200-day. So that break was non-confirmed because it was never confirmed by a lower low from that initial break. So what we'd be looking for is a rally back to the 200-day moving average. And if this was going to be a resumption of the bear market, the market would have rallied back to the 200-day, failed, and then broke the low before it rallied. And so when it took out that bottom of support, right around 3,800, that's where you short the market, you start taking off a lot more exposure. So in other words, exactly the opposite strategy of when markets are rising and buying dip. You just keep selling rallies when it looks like the next bear market. You're not going to get it out at the top. That's not the goal of investing. It's also not the goal of investing to try to buy at the exact bottom either. That's how you get hurt. That's what happened to a lot of people back in June of last year. They tried to buy that bottom and got monkey hammered. But the goal is to slowly work yourself out over time so you can ensure that you're on the right side of whatever the trend of the market is.
All right, that's super useful explanation. Obviously, you're telling us what you're going to be looking for here to determine a change in your portfolio strategy here in terms of playing to the bullish cycle right now. Lance, I'm thinking we should maybe bring that chart up more frequently in programs going forward, even just for a minute or two, whatever, but just to sort of mark where we are for folks on that. Because I think that is it's really useful. It's just sort of a sense of like, hey, if you're a market bear right now, I think what you would say is that's fine, but just look where we are. It doesn't look like this is something that's going to like waterfall, tomorrow, right? Because it has to go through those individual milestones that you talked about, right?
Right. Yeah, and just for your subscribers, if you go to realinvestmentadvice.com, you can subscribe to our daily market commentary, and every day we send out a very quick read. It takes you about 3 minutes, basically gives you the earnings of the day, the economic data of the day, and we provide a market trading update every day just to tell you exactly what the market's doing. We change the charts up every now and then, but we just kind of tell you, this is where the market is. We broke out, this is bullish, or this is a warning. But we give you a market trading update, and it comes out at 7:30 Central Time. So it's an hour before the market opens, and I give you time to get set up for the market.
All right, great. So they go to realinvestmentadvice.com, and where do they sign up for this thing?
It's right on the homepage. There's a link for the daily market commentary. It says subscribe. So
okay, awesome. Everybody should do that. But Lance, I'll try to remember to ask you to just pull that up more frequently going forward on this program, just to give us a quick little heartbeat check of where we are. All right, I want to get to your trades in just a second. Real quick, we mentioned this super briefly earlier, but we didn't really dive into it at all. We got the new CPI numbers this week. As expected, it came down pretty substantially. It ended up at 3.0 for the headline CPI. Core still a bit stickier, but still coming down a bit. And, I think a lot of people who don't track the macro data the way that we do, as closely as we do, probably look at that and think, oh, okay, look, hey, inflation's really getting under control. 4 to 3, big drop, just 1% more until we're at the Fed's 2% target. Like, hey, what inflation? We don't need to worry about it anymore, right?
Yeah.
A couple of things. One, we've talked about the base effects and how it is probable that the CPI will start ticking up over the rest of the summer, or at least for many months, a couple of months in the next couple of months, we'll say at least. And that's just from the math of the year-over-year comparisons here. So folks watching, don't be surprised if that happens, right? We want to make sure that you're not freaking out if you see CPI start going up here a bit. The Fed clearly still doesn't think it's on easy street, right? It is still saying it's going to hike, most likely twice. And it's not going to be cutting rates this year. So they're not taking their foot off the gas necessarily. They're going to continue QT. So the Fed isn't like super sanguine yet that the inflation battle is won. Anything else come out this week around the CPI number you think is worth discussing?
Well, no, I think two things. One is that, CPI and PPI both, came in a little bit weaker than expected. So clearly disinflation is, in the economy. And when you and I talked about this in June of last year, when inflation rates were raging, we said, hey, disinflation's coming. You're just going to have to give it time. And so we're there. There's certainly a case on the mathematical basis that we may see inflation tick up mildly. And that may be the one catalyst that maybe takes some of the wind out of the market. If the market sees CPI tick up a little bit, maybe they get concerned that the Fed's going to remain more aggressive. Maybe that pulls some of the wind out of the market. The one caveat to that statement, though, is to pay attention to the housing and homeowners rent equivalent, which is what drives a big chunk of CPI. That's running a big lag effect. There's about a 3-month lag to that data. So there's about to be a very big downward impulse of homeowners equivalent rent coming down. That's going to start to potentially weigh on CPI as well. We'll see how that base effect works out as that homeowners equivalent rent decline starts to catch up with CPI. But again, I think there's, just from math, like you said, from a mathematical standpoint, if we're just clipping off 0.2, 0.3% inflation over the course, and this is really kind of be starting in August, September, we could see inflation start to tick up just a little bit simply because of that mathematical comparison.
All right. And there's a chart I'm going to try to find here. I put it up in the past couple of videos. It's a chart that shows the change in M2, right? The change in money supply, which has gone negative this year, right? For the first time in forever, decades and decades and decades.
Exactly.
It's not a metric that generally shrinks. And it shows that it has a very tight correlation with the change in CPI, core inflation, PCE, the inflation metrics that the Fed looks at. But it leads them by about 16 months. And look, that makes total sense, right? You issue a bunch of money, and then soon after in the economy, you see inflation begin to rise, right? So what that graph is showing right now is now that M2 has gone negative, if this correlation continues to hold, it shows that we could be in not just continued disinflation, but outright deflation in a year and a half if this tight correlation continues. And I don't think there's a reason to expect that it's not going to continue, but I'd love to hear thoughts to the opposite if folks have them. But I'd just love to get your thoughts on that. I mean, do you think we actually could be in deflation, in a year from now, year and a half?
Sure.
From now?
Yeah, no, sure. It's entirely possible. But real quick, we got to go back. It's all about math, right? So, think about money supply like an allowance, so to speak. So, if I give you $1 in allowance, today, and then next week I give you $2, you've had 100% increase in your rate of change in your allowance, right? Mm-hmm. And that's what we did. See, and that's what we did with money supply. We had this anomaly come along in the data that wasn't normal. And that was that $5 trillion worth of liquidity that created this massive spike in M2 as a function. Well, now a year later, we're obviously not doing that. So the $2 in allowance now goes to 50 cents. And you've had a big negative decline in your allowance, right? And so that looks terrible. Obviously, you're spending less, so that certainly has an impact on the economy. And you certainly you are currently experiencing deflation in your allowance, right? Mm-hmm. So no doubt about that. But what is happening is that we're returning back to normal in terms of the rate of change in monetary increases, or M2, in the economy. But M2 as a percentage of GDP is still extremely elevated, which is what is creating this problem to where all these, ideas about a recession occurring within 6 months or 9 months hasn't occurred, because there's still so much liquidity sitting out there. Don't forget, not only did we do the $5 trillion in stimulus, but when Joe Biden took office, they did $1.7 trillion in the Inflation Reduction Act. That's still coming in. That's why industrials have been performing so well, because of all that money pouring in. That's keeping inflation elevated, it's keeping economic activity going. Right. And
when
all
we talk
that,
about the pig and the python, it's like
yeah.
the pig, yeah, it's still in the python, but they're shoving additional pork chops into the snake's mouth.
Exactly. So that's one of the frustrating points. So I just want everybody to be careful is that you're absolutely right in what you're saying. I run this chart all the time, the 16-month lag between M2 and GDP, it's the correlation is extremely high. You had a big spike in money supply, you had a big spike in GDP growth. That's all going to work itself out over time. That's why we are going to have disinflation and probably ultimately deflation. We will probably get some quarters coming up to where we have negative inflation. That is deflation. And that's also going to be problematic ultimately for the markets because remember, corporate earnings and profits, which are coming down, are a function of inflation. And so if you have deflation or more severe levels of disinflation, that is going to continue to weigh on profit margins and earnings, which is going to make it very difficult to support, a market at 5,000, 6,000, wherever the analysts think we're getting there.
Okay. All right. Well, look, I'm going to get to your trades in just a sec. Real quick, potential detour through the consumer. There's been data that's been coming out, but I've also been hearing increasing number of anecdotal evidence from a number of the experts I've had on this channel here. When I was interviewing Eric Besmajan, he said he'd literally just gotten off a phone call before he hopped on the interview with me with a trucking company owner who basically said they're now laying off people, biggest layoff they've ever had to do, huge reversal from where they were just a year plus ago. So it does seem like, especially in the leading parts of the economy, the highly cyclical parts of the economy, we're beginning to see some pretty dramatic slowing down there. Some stories online this week about like Disneyland in mid-July seeing way fewer crowds than they expected. I've seen, and you'll appreciate this, I've seen some data that shows that consumer spending is falling pretty dramatically year over year in terms of units purchased. Right. So you and I have talked about, if you look at like retail sales, it can be a little bit deceptive because it's priced in dollars. The transaction, it's measuring the total dollars of transactions, which are being influenced by the inflation, the price inflation that's gone on. But if you just look in terms of units purchased, those are down fairly substantially. Right, yeah. Which is showing that consumers are just able to buy, or that they are buying fewer things, right? So anyways, we don't have to spend a lot of time on this, but I'm just curious if you have any sort of update from your world of how the consumer's faring right now.
We see that in some of the data. I mean, consumer sentiment is improving, not surprising, because you're seeing a big rise in the stock market. The wealth effect is feeding into that. But take a look at stocks. I mean, FedEx is at all-time highs. UPS has had a huge rally over the last several months. Norfolk Southern, Union Pacific, big rallies in those stocks. So it's certainly, despite the data saying, hey, trucking companies are shipping less and, we're laying off workers, the stock market's going, yeah, whatever, everything's fine. So let's buy those stocks. Kind of like home builders, right? Home builders trading at all-time highs too. It's just, all these things that, and this is the important thing to remember, is that you've got to be careful between the data and what the market's doing short term. Does it mean the data doesn't matter or the data is wrong? No, the data is absolutely right. But right now, investors are chasing stocks on expectations that the worst is now behind us and it's about to get better going forward. And the question is going to be, is the market right or is the economic data right? And remember, the market tends to lead the economic data by 6 to 9 months. So the market is saying that in 6 to 9 months, all that data that you're talking about is about to start getting better. We'll see, but that's what the data says.
All righty. Okay. Well, look, wrapping things up here, starting to wrap things up. Trades. What trades have you guys made over the past week?
Well, so like we talked about it earlier, we added to Apple, we added to Google, we added to our position in Amazon here. Of course, we're going to earnings as well. So, they're starting to see a lot of positive bias. We had corrections, kind of pullbacks, to an entry point. We could add a little bit more exposure. These weren't new buys. These were positions that we've owned for a long time. We're just increasing the position size in the portfolio. Previously, we had added to AMD and companies like some of the smaller cap names. We bought regional banks previous this year, like Truist and PNC. We had also bought companies like Stanley Black & Decker. Those have been performing a lot better lately because small cap, mid cap stocks have been really kind of picking up the pace here. So we're starting to see that kind of a shift now from some of the large cap names into some of the smaller mid cap names. And yesterday, we just started nibbling a little bit on IWM, which is the Russell 2000 index. So we're just kind of going to slowly start building a position. If small cap, mid caps are going to continue to pick up the pace here a bit, they're pretty overbought short term. So we're kind of just bought a little bitty holding position right now. And then we'll add to that position on pullbacks to support that don't fail. And so we're kind of watching that very carefully.
Okay. And these positions outside of the big seven, is that playing a rotation of capital out of the big tech names into them, or is it instead of an or, is it an and? Is that you expect kind of the rising tide to begin to rise everything, and now the unloved parts of the market are starting to get capital, but it's not necessarily stealing away from the big caps?
That was kind of our position earlier this year. And again, one of the reasons that we underperformed is that we said, yeah, tech's running, we've got exposure, that's fine. But I talked with you several times, showed you the charts from SimpleVisor about the rotation of the market, et cetera. And, we're clearly seeing that. In fact, I'll just show you, I've got them right here. We talked about previously that, technology, communication, discretionary, they were extremely overbought. That's still the case, but all those other sectors that are now red and gray were all green. They were all bright green, saying they were really oversold. So we've seen this rotation in the markets now over the course of the last, several weeks in particular. And that's kind of what you would expect to occur. And that's one of the things, I need to move this thing. And the same thing here, this is the relative and absolute analysis of sectors. So this is just how are sectors of the market positioned on an absolute relative basis to the S&P 500. Before, they were all in the left-hand quadrant down at the bottom. Now you can see they're all kind of moving up towards the other side. So that rotation in the markets in both the sectors as well as, kind of the absolute factors of the market, whether it's small cap, mid cap, large cap, buyback achievers, whatever it is, equal weight, all that was crammed over in that lower left quadrant relative to the S&P has now been moving up. And you see even ARK now is trading, well up into the overbought territory. So, ARK, which is those, definite meme stocks, have had a huge run as of late, as money's now starting to say, okay, I missed the boat on Apple, Microsoft, NVIDIA. So now I'm going to buy everything else. And those are starting to come up into the market. So that rotation is occurring. And we positioned for that earlier this year. And now it's finally starting to pay some dividends, so to speak.
Okay, I'm really glad you shared all these charts, but particularly these scatter plot ones, because that was the question I was going to ask you, which is, it's not so much that money is rotating out of the big name stocks and that they're coming into being less overbought. It's more they're staying in the overbought territory, and the rest of everything else is coming up to them, right? Yeah, and that was actually really pretty true in the last two charts you showed. I don't know if there were any data points left on the oversold side of the market anymore, right? On that relative basis.
Yeah, there's nothing that's oversold now. We added, by the way, if you like our SimpleVisor platform, we just added a new feature this week, and so when we place trades, you actually get a text message now.
Awesome. Hey, let's talk about your platform for 1 second too. So,
sure.
Every week I recommend that folks set up a free consultation with our advisors, your firm included. Your firm is the primary firm. Well, you service client accounts all across the entire spectrum, but because of you have additional solutions, you've got a platform that really is offers the most to people with the lowest amounts of capital, right? If they're just starting out, right? You've put together, I don't want to call it a robo advisor, but basically a platform that lets you help those people, and then eventually they graduate once they've amassed a certain amount of assets to be able to get sort of the full service from you guys. I know that there's been kind of a curveball thrown into that industry because some of the players changed their APIs. I know you're working with them to get that eventually fixed and have that service back up and running at full speed. So I just for the people here that are watching that have, say, below, I don't know, $100,000, $150,000 worth of money to invest. if they come to you right now, what can you do for them? And then what will you be able to do for them once those technical issues are fixed?
Yeah. So what happened is that we had our platform up running earlier this year, and the company that was providing the linkage between us and the custodian went out of business. So we have now switched over to advisor engines and using Fidelity as a custodian. So that'll be turned on at the beginning of August. That's the goal right now. So the thing is that, when you have less than $150,000, yeah, an advisor would love to take that from you because they're going to charge you a fee on it and throw you into some buy and hold ETFs and not talk to you, right? Because that's the only efficient way to do that. The problem with that is that it's very hard to generate a return on a small amount of money. That fee is going to eat too much into your return that you're going to have in your portfolio. Because again, just a small amount of money makes it, even if you have $100,000 and the portfolio is up 10% in a year, that's 10 grand, right? It's really hard to create, growth every year on $100,000 and justify paying a fee to an advisor. You're much better off, investing in the S&P 500 index and just saving as much money as you can until you can get to a level to where you can actually start to diversify your portfolio, take advantage of other opportunities, and do other things. And that's about $250,000. That's why a lot of advisors say, hey, we only do 500,000 or more, whatever it is, because if it's a good, credible advisor, they're not going to want to charge you a fee for managing your money, plus providing you financial planning, all these other things. It's just too costly to the firm and to the individuals. And so there's a cost relationship here that does matter, and it matters a lot to you. And so, if you're just starting out, save aggressively. That's your big thing. Pay off debt, save aggressively, get your emergency fund put together, and then start building an investment account. And for right there, you can just do an S&P index fund. You don't have to get fancy. It's all about saving money and letting it grow over time. And then you can graduate to a financial advisor where it's worth paying a fee. Now, the advantage of what we can provide with SimpleVisor is we can provide because it's all automated, and this is when the APIs come back online in August, because it's automated, because there's not a direct manager managing your portfolio, we just make decisions at the top. The software automatically automates that. We can provide a very cheap service to manage smaller amounts of money. And to Adam's point, once it becomes large enough that we can justify applying full management to it and doing all the other stuff, the financial planning, everything else that's required to help you get to your retirement goals, that we can justify you paying that fee, and it's fair to you and fair to us, then we'll call you and say, hey, it's time to move you over to our private client group. But we'll have that tool available. But you can do it yourself as well. But what the service will provide is our risk management tactics at a much lower cost.
All right, excellent. So just wanted to make sure that we clarified that, because I think, folks that are on just starting out or have a lower amount of assets, they obviously have the most to gain and most to lose in this process. And I want them to know that we're working as hard as we can to help meet their needs. So when those APIs are fixed and the whole service is back up and running, Lance, we'll make sure that you let folks know on this channel too. All right, well, look, I'm going to have to wrap things up here because I just got a phone call while Lance was giving that his last answer there. My time is up in this rented room here, and I'm going to go down and see if they've called the cops on me, thinking I'm running some sort of crazy, nefarious, morally dubious OnlyFans or whatever out of here. But real quick as we wrap up, I'm out here taking care of my mom's effects. I'm going to leave here to writing the eulogy for her service. But this whole experience for me has been, again, just a massive refresher in all of the issues that come up when dealing with an aging parent, perhaps being an aging senior yourself, preparing for all the end of life issues. As I said, weeks ago when this happened, the lesson here is there's just so much that can be improved and so much chaos that can be avoided with a little bit of advanced planning here amongst families before a key senior family member passes on. And so you and I have talked about doing a webinar with your personal finance guys, with Richard and Danny, about kind of end of life planning, senior living planning, all of that type of stuff. I think we're zeroing in on a date, but we feel pretty confident, Lance, right? We're thinking at least it's going to be in the first 2 weeks of August, and we'll have the exact date next time you come on the channel.
Yeah, absolutely. Yeah. They're just finishing up putting together the whole presentation. And so we've got an economic, on July the 24th, we've got an economic summit that we're putting on, and that's where we're going to talk about the markets coming year. So as soon as once we get past that one, we're trying to get all that put together right now. So once that summit is over, then we'll get this one done. So I think probably in the first 2 weeks of August, we can get this put together for you.
All right, thanks. And like I said, folks, as soon as we've got the hard date, which hopefully we'll have next week, we'll let you know so you can get that on your calendars. All right, well, look, always great with you, Lance. Everybody else, if you can do me a favor, if you're watching this weekend, and just send a little good vibe out into the universe for Priscilla. It would mean a lot to my family and I. Look, I'll just wrap things up by saying, as I do every week, if you're trying to navigate these markets, whether you're trying to manage the FOMO or you're trying to position for what the fundamental data thinks is coming ahead in terms of tougher times for the economy and eventually the markets, I think we did a really good job this week, Lance, explaining what a good financial advisor can do for you in terms of thinking through all this stuff. So if you've got a good advisor who's doing that for you, great, stick with them. Make sure they take into account all the macro issues that we talk about on this channel. But if you don't have one, or you'd like a second opinion from a good one, perhaps even Lance and his team there at RIA, then consider scheduling a free consultation with the financial advisors that Wealthion endorses. To do so only takes you a couple seconds. Just fill out the short form at wealthion.com and we'll help set you up with them. Totally free, no commitment to work with these guys, just a free public service they offer. If you enjoy these weekly market recaps, no matter where in the world we hold them, sometimes even from sketchy hotel rooms, do Lance and I a favor and vote your support for this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Lance, as always, you get the last word, brother.
Make sure and subscribe to Adam's OnlyFans channel, because it's the most boring channel on the network. But
hey, there's lots of econ porn on there, lots of macro porn on that one.
There you go. That's it. Have a great week, and we'll be back here next Friday.
All right. Thanks, buddy. Everyone else, thanks so much for watching.